Hello and welcome back to the channel. If you're joining us for the first time, please consider hitting that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. Imagine discovering hidden truths that could save you thousands of dollars, unlock new opportunities, and give you the financial freedom you've always dreamed of. Sounds too good to be true? Stick around, because what you're about to learn will make you rethink everything you thought you knew about your credit score. But that's not all. At the end of this video, we've got two special bonuses for you: a key takeaway section to recap all the crucial points, and an actionable exercise to help you implement these insights in your life. These bonuses are designed to ensure you can immediately start making positive changes to your financial health. So, get ready to take notes, because these insights are game changers. Let's get started. 1. Understanding credit scores. Your credit score is a 3-digit number, typically ranging from 300 to 850, that indicates your credit worthiness. Think of it as a financial report card that lenders use to decide if they should lend you money. A higher score suggests you are more likely to repay debts on time, while a lower score indicates higher risk. Understanding how your credit score is calculated can help you better manage your financial health. For instance, paying your bills on time, keeping your debt levels low, and maintaining a long credit history all contribute positively to your score. When was the first time you heard about credit scores? Do you think there could be a better alternative to credit scores in our financial world? Let us know in the comments section. 2. Credit scores in daily life. Credit scores play a crucial role in daily life in the U.S. They affect your ability to rent an apartment, get car insurance, and even secure a job. Without a credit score, you might find it challenging to access these essential services. Around 45 million Americans don't have a credit score, making it difficult for them to fully participate in modern society. This lack of a score can limit their opportunities and increase their financial vulnerability. Ensuring you have a credit score and working to improve it can open doors and provide financial stability. For instance, John, a young professional, had no credit score because he always used cash for purchases. 3. Unintended consequences. Credit scores were designed to make lending fairer and reduce human bias. However, they have become very powerful and sometimes lead to unintended issues. A low credit score can result in higher interest rates, making it more expensive to borrow money. This can create a cycle where it becomes harder to achieve financial stability. While credit scores help lenders assess risk, they can also perpetuate financial inequalities if not managed carefully. It's important to understand both the benefits and drawbacks of credit scores to navigate the financial landscape effectively. What would you do if you were in the position of Lisa? Would you take a loan with a higher interest rate, or would you work on improving credit score first? 4. How credit scores are calculated. Credit scores are derived from your credit report, which includes data from banks, credit card companies, and other financial institutions. Different scoring models, like FICO and VantageScore, use this data but weigh factors differently. Key factors influencing your score include your payment history, amounts owed, length of credit history, types of credit in use, and recent credit inquiries. Knowing what impacts your score allows you to take steps to improve it. Regularly checking your credit report can also help you spot errors that might be affecting your score negatively. For instance, Mark was surprised to find his credit score lower than expected. 5. Impact of low credit scores. Having a low credit score can significantly increase the cost of living. When you have a low score, lenders see you as a high-risk borrower and charge higher interest rates on loans and credit cards to compensate for the risk. This can lead to a cycle of debt, as higher interest payments make it harder to pay down balances. Additionally, Low credit scores can make it difficult to rent an apartment, obtain affordable car insurance, or even secure a job. These barriers make it challenging for individuals with low scores to improve their financial situation. 6. Boosting your credit score. Improving your credit score involves several strategic steps. First, always make payments on time, as payment history is a major factor in your score. Second, reduce your outstanding debt by paying down balances, particularly on high-interest accounts. Third, keep old credit accounts open to maintain a longer credit history, which positively affects your score. Fourth, avoid applying for new credit frequently, as multiple inquiries can lower your score. Finally, regularly check your credit report for errors and dispute any inaccuracies. These strategies can help you build a stronger credit profile. 7. Historical biases in credit reporting. Credit reporting has a history of biases, often against women and minorities. Despite changes in the law, these biases can still indirectly affect credit access. Employment history and neighborhood conditions, for example, can reflect racial biases and impact credit scores. Understanding this history is crucial for recognizing the systemic issues that still influence credit worthiness today. Have you ever seen a case of credit bias in your area? What measures do you think should be taken to prevent this from happening? Let us know in the comments. 8. Generational wealth impact. Historical credit policies have created significant wealth gaps, particularly affecting minority communities. Discriminatory lending practices in the past have led to generational differences in wealth. For example, post-World War II mortgages were more accessible to white families, creating a cycle of homeownership and wealth that was often denied to minorities. This cycle has had long-term effects, with minority families having less accumulated wealth and home equity to pass down through generations. Understanding these impacts helps highlight the need for systemic changes to promote equity and credit access. 9. Credit scores beyond lending. Credit scores are used in various non-lending areas such as employment and insurance, affecting more than just your ability to borrow money. More than half of U.S. employers use credit scores in their hiring decisions, which can disadvantage job seekers with low scores. Additionally, insurance companies often set premiums based on credit scores, making insurance more expensive for those with lower scores. These practices can further entrench economic inequalities, making it harder for people with low scores to improve their financial situation. 10. Solutions for a fairer system. Innovative solutions are emerging to address the inequities in the credit system. Some regions are leading the way by banning the use of credit scores in non-lending decisions, such as employment and insurance. This helps ensure that credit scores are only used for their intended purpose, assessing credit worthiness for loans. Additionally, alternative scoring models are being developed that consider factors like rent and utility payments, which are often not included in traditional credit reports. If you could implement one rule to make the financial credit system better, what would that rule be and why? Share your thoughts with us in the comments. 11. The role of credit bureaus. Credit bureaus, such as Equifax, Experian, and TransUnion, play a crucial role in the credit system. They collect and maintain information about your credit history from various sources, including lenders and credit card companies. This data is compiled into your credit report, detailing your payment history, debt amounts, and any negative marks like bankruptcies. Credit bureaus use this information to calculate your credit score. However, since each bureau might have slightly different data, your scores can vary. Regularly checking your credit reports from all three bureaus helps ensure the accuracy of your information and allows you to manage your credit effectively. Bonus 1. Here are the 8 key takeaways from the video. 1. Understanding credit scores. Your credit score is a 3-digit number between 300 and 850 that indicates your credit worthiness. It acts like a financial report card for lenders to assess risk. Higher scores mean you're likely to repay debts on time, while lower scores indicate higher risk. Paying bills on time, keeping debt levels low, and maintaining a long credit history are key to improving your score. For example, Sarah improved her low score by setting up automatic payments and paying down debt, which helped her qualify for a better car loan rate. 2. Unintended consequences. Credit scores were created to make lending fairer, but they can also lead to higher interest rates for those with low scores, making financial stability harder. While they help lenders assess risk, they can perpetuate financial inequalities if not managed carefully. For example, Lisa, with a low credit score, was offered a high mortgage interest rate. By improving her credit score, she saved thousands of dollars in interest on a subsequent loan. 3. How credit scores are calculated. Credit scores are derived from your credit report, which includes data from banks and credit card companies. Different scoring models like FICO and Vantage Score weigh factors differently. Key factors include payment history, debt amounts, credit history length, types of credit, and recent inquiries. Regularly checking your credit report can help spot errors. For example, Mark discovered an error on his report, disputed it, and saw his score improve, helping him get a better car loan rate. 4. Boosting your credit score. Improving your credit score involves several steps: making payments on time, reducing outstanding debt, keeping old accounts open, avoiding frequent new credit applications, and checking your credit report for errors. These strategies can help build a better credit profile. For example, Maria paid down her debt and set up automatic payments to ensure she never missed a due date, improving her score and getting a lower interest mortgage. 5. Historical biases in credit reporting. Credit reporting has historically been biased against women and minorities. Despite changes in the law, these biases can still indirectly affect credit access. Employment history and neighborhood conditions can reflect racial biases, impacting credit scores. Understanding this history is crucial to recognizing systemic issues in credit worthiness. Early credit reports often excluded women and minorities, perpetuating economic disparities. 6. Credit scores beyond lending. Credit scores are used in non-lending areas like employment and insurance. More than half of U.S. employers use credit scores in hiring, affecting job opportunities for those with low scores. Insurance companies also set premiums based on credit scores, making insurance more expensive for those with lower scores. These practices can further entrench economic inequalities, making it harder for people with low scores to improve their situation. 7. Solutions for a fairer system. Innovative solutions are emerging to address credit inequities. Some regions are banning the use of credit scores in non-lending decisions like employment and insurance. Alternative scoring models that consider rent and utility payments are being developed. Empowering local credit unions and nonprofits to report these payments can help build credit histories. For example, Jane improved her credit score by including her rent and utility payments, qualifying for a lower interest loan. 8. The role of credit bureaus. Credit bureaus like Equifax, Experian, and TransUnion collect and maintain your credit information. They gather data from lenders and credit card companies to create your credit report, detailing your payment history, debt amounts, and any negative marks. Credit bureaus calculate your credit score from this data. Checking your credit reports regularly helps ensure accuracy. For example, Tom found a mistake on his report, disputed it, and improved his score, helping him get a better car loan rate. Hey everyone, thanks for watching the video. I hope you found the takeaways helpful. I'd love to hear from you. Which takeaway resonated with you the most? Please drop a comment below and let me know why it stood out to you. Your feedback is super important and helps me create even better content for you. Can't wait to read your thoughts. Bonus 2, here are 8 exercises on how to implement the takeaways. 1. Understanding credit scores. Check your current credit score using a free online service like Credit Karma or annualcreditreport.com. Identify the factors that are positively and negatively affecting your score. Write down 3 specific actions you can take over the next month to improve it, such as setting up automatic bill payments or reducing credit card balances. 2. Unintended consequences. Calculate the total interest you are paying on your current loans and credit cards with a low credit score. Compare it with the interest you would pay if you had a higher credit score. Create a budget plan to allocate extra payments towards high-interest debt, aiming to reduce your overall debt load and improve your credit score. 3. How credit scores are calculated. Obtain a copy of your credit report from all 3 major credit bureaus: Equifax, Experian, TransUnion. Review each report carefully for accuracy and discrepancies. If you find any errors, follow the bureau's process to dispute and correct them. This can help improve your credit score. 4. Boosting your credit score. Set up automatic payments for all your recurring bills to ensure you never miss a due date. Additionally, make a plan to pay off at least one outstanding debt. Keep a journal of your payment activities and review your credit score every month to monitor improvements. 5. Historical biases in credit reporting. Research the history of credit reporting biases and write a short essay on how these biases have impacted financial access for different groups. Share your findings with friends or on social media to raise awareness about the importance of fair credit practices. 6. Credit scores beyond lending. Make a list of non-lending areas where credit scores can impact your life. For example, employment, insurance. Research and write down alternative methods these companies could use to evaluate candidates without relying on credit scores. Consider writing a letter to a local representative advocating for fairer practices. 7. Solutions for a fairer system. Investigate local credit unions or nonprofits that offer programs to report rent and utility payments to credit bureaus. Enroll in one of these programs if available, and track how these payments start reflecting on your credit report. Share your experience with others who might benefit from these programs. 8. The role of credit bureaus. Schedule a regular review of your credit reports from all 3 bureaus at least twice a year. Set reminders on your calendar to check for accuracy and update any discrepancies. This regular monitoring helps maintain an accurate and healthy credit profile. Do you know how ways to become a millionaire? Click on the screen and discover. See you there!